it gives me great pleasure, obviously, to introduce Anne from Calpers, and having the opportunity to have this cosy one-on-one session to talk about, I guess, the trials and tribulations of being an asset owner and talking about that sustainable journey and that sustainable transition. So firstly, welcome, Anne.
Thank you.
And let's start there, actually. Let's start with the genesis for Calpers Journey into ESG and into a sustainable journey. And if you could give us a sense, and the audience a sense, of whether that was a particularly easy or was it a particularly painful journey?
Well, thank you very much for inviting me. It's wonderful to be joining everybody for this important event. So CalPERS is a very large pension fund. I realize because we're over in California, it might not be a name that many people know. But CalPERS is one of the biggest asset owners in the world, one of the top 10 funds. We have a portfolio of something like $400 billion and more. So when we're looking at any sustainability issue, we have nowhere to hide. We're so big, we'll get sometimes called a universal owner. We own a little piece of everything. So there isn't an option for CalPERS with our size to just find this neat and tidy or safe or green corner of the stock market to tuck that money away. We've got very demanding investment objectives for a social purpose. I mean, the purpose of a pension fund is to invest in order to pay pensions, and that is a public good, taking care of people for a pension fund. CalPERS is also the second biggest health system in the United States, so it's not just people's retirement, it's also their health. Now, although that $400 billion or more sounds like a lot of money, it's actually not enough. We rely on investments to make up the gap between the contributions that are put in and what we pay out. So at the moment, if you look at what we call the CalPERS pension buck, nearly 60 cents of every single dollar that we pay to our nearly 2 million members in California, it comes from investments. So that means everybody putting money into the stock market, everybody relying on investment returns, has got an interest in the financial system working, because the purpose of the financial system ultimately is to serve society's needs and wants. So why does that matter? And thinking about sustainability, when you're as big as CalPERS and you're a pension fund, there's another side to think about, which is your time horizon. And a pension fund is an intergenerational investor. So if we were even to think about shutting the doors at CalPERS in the morning, we would still have to keep going for probably the best part of a century, because the youngest members of our scheme won't retire for a very long while, and they also have dependents. So that means we're a universal owner. What's going on out there really matters. We can't hide. And it also means we're looking ahead in the long term, beyond, you know, people talk about long term being 5 years, 10 years. For us, it's not. We model our liabilities in 30-year cycles. So when you say, is the sustainability issue painful or difficult, I would put it a little differently. I would say it's necessary. It's actually fundamental to us being able to continue to pay those returns. And when we started on this process some years back, I think CalPERS was involved in many initiatives right at the very beginning. The founding of the International Corporate Governance Network, some of the first clean tech portfolios in venture capital, proxy voting, corporate governance. We have had a responsible contractor policy for a long time, so that with our real assets and infrastructure, we're making sure our managers report in on what's happening with the workers. All of that. What we haven't had until I guess 2015, 2016 is a strategic plan on all of this. And that was one of my first jobs when I came, was to say, why is this part of our investment job? Why is this part of our fiduciary duty? And what do we focus on and how? And by what measure do we know if we're making any progress?
which, yeah, I can relate to that, but particularly the idea of having multi-generational members. And obviously one of the great difficulties of setting strategy for pools of assets that are essentially asset liability linked is balancing, I think, the old doctrine of what constitutes risk against these new existential risks as they're coming in, climate change, etc.
Right.
So what I was thinking then about whether that journey was painful was literally the process of, I guess, of engagement in terms of getting the decisions that you needed to get made through committee, but also, I guess, the member engagement side. Was that particularly difficult? Because at the time when Calpers started to do this, Calpers was obviously well ahead of many other pension schemes in the world at that point in time. So this would have felt new then. And was that particularly difficult?
It didn't feel difficult. It felt like a necessary challenge. Well, let's take the example of climate change. So when we were considering, well, where does climate change show up, for Calpers as a risk, but also as an opportunity? It was such a big topic. It's a systemic risk. We this year have identified climate risk as one of the top 3 risks for Calpers. So slowly but surely this has been elevated as our understanding of the issue has improved. Yeah, so this issue about working out a sustainable investment strategy, is it difficult? Is it painful? It doesn't feel painful. It feels necessary and it feels like a great big challenge. But typically if something's important, it's not going to be easy. So you may as well get ready and roll your sleeves up for that one. The way that we approached it at Calpers was over about a 2-year process where we had a lot of dialogue and discussion with the Calpers board, which is a stakeholder board. We have our own members elect representatives to the Calpers board, and then other stakeholders like the legislature who represent the taxpayers. They have appointments to the board, and then the state treasurer and the state controller both sit ex officio on our board as well. So it's a very diverse and very broad board where I think the voice of the broader community can be heard. The job, when you come to this from an investment point of view, is to think about what matters to risk and return. So the first step for us was to commission a review of research, like what's the evidence about what matters? There are 1,001 things out there that could matter. And secondly, it's not just does it matter, but is it something which an investor of our size with our investment objectives that we could or should pick up and do something? What came out of that research process, which we called the Sustainable Investment Research Initiative, or SIRI for short, although I think we did get ahead of Apple on that, and they've never been unkind to us. But anyway, this Sustainable Investment Research Initiative let us really review all of the literature, and we did it in a disciplined way with the help from academics. That showed us that there were a number of issues that mattered right across our portfolio, whenever, wherever, however we allocate capital. One of the issues was climate change. Another was diversity and inclusion. Another was the lack of consistent corporate reporting and very poor data, and so on and so forth. But by working out what these priorities were, we then said we develop a strategy which is specific to these issues. And on climate change, we decided that the most useful thing that we could do is articulate 3 channels of influence as an asset owner. The first is advocacy. In other words, we need to be there talking with and engaging with policymakers and regulators. You'll have seen the work that we've done at the CFTC with their very important report. It's the first US regulator to come forward with recommendations. My colleague Divya Mankikar sat on that commission, and we're very proud of that work. We've also had a voice at the SEC where I sit on the Investor Advisory Committee for Calpers, and there we've argued that we need to have a risk reporting framework that reflects these issues. And we've had the same voice at places like the IFRS on international accounting. So I want to say we've made fantastic progress there, and we're very excited about the recent IASB advice about how to integrate climate risk. So that's one issue, advocacy. Asset owners need to speak up. Could, should, and must. The second track for us is what we call engagement. And that's really following the money. When you put money with a manager or you're investing directly in a company, and about 80% of Calpers' portfolio is directly invested. So we have that immediate connection, if you like. We're not going through third parties with our investment decisions. What that means is you have an opportunity to consider your rights and your responsibilities as a part owner of this enterprise. And what we did on the climate change issue was roll out a carbon footprint for the 10,000 or so companies in our public equity holdings. And to mine anyway, amazement, of the 10,000 companies, we found that about 100 are responsible for the majority, the vast bulk of the emissions. So I remember going to have tea with Mark Carney, who was kind enough to sit and look at these results with me and say, look, this looks like the climate equivalent of systemically important financial institutions. You know, the idea that you've got some that are too big to fail, and if they do fail, they take so many others down with them. So you can't just isolate the risk to that particular holding. So we realized that these 100 or so companies are, in effect, the systemically important carbon emitters. And what I think we appreciated was, well, if this is true for Calpers, it's probably true for our fellow asset owners as well. So we convened a series of meetings that were hosted by the French ambassador to the UN, François de Lattre, and Sophie Lelias. Thank you, because they gave us a lovely place to have breakfast and talk ideas through with other investors. And out of that came the idea of climate action 100 plus. In other words, that if, you know, the major asset owners and managers have a shared agenda with these systemically important carbon emitters, we can actually do something with real impact to bring emissions down. Now that group of companies, we say it's a lot in terms of emissions, but just to give you a sense of the scale, those 100, just the 100 companies, not the plus, just on scopes 1 and 2 emissions, like the very direct and immediate emissions, if they were just a country, they would be the third source of emissions on the planet. So in terms of absolute emissions, it would be China, then the United States, and then these 100 companies. So Climate Action 100 had really this vision, not just of overcoming the tragedy of the horizon, as Mark Carney very eloquently put it, but the tragedy of the commons, which is because in the financial system, asset owners and managers typically are diversified. They hold a little bit of everything. And that's designed to allow you to manage risk. However, there are certain risks you can't diversify away from because it's going to hit you. And that's absolutely true of climate change. Where we are now is we have around $47 trillion lined up through the Climate Action 100 Plus initiative. And we're taking these very, very heavy emitters and engaging them to say, you need to do 3 things. Number 1, be accountable, board governance. We need to be able to vote and hold boards accountable. That also covers issues like remuneration, incentives, compensation. It also includes issues like the just transition, that the board needs to be accountable for the climate change transition taking place in the way that the Paris Agreement intended. And if you go back to the preamble to the Paris Agreement, it's all about ensuring that the transition does not, the brunt is not borne by vulnerable groups. So governance, number 1. 2, for these companies to set targets of coming to net zero emissions by 2050 at the latest. For most of these companies, this means a cut in emissions in the order of 70, 80, 90%. So this is not for the faint-hearted. This is a business transition at scale. And the third issue, of course, is tell us all about it. We want you to report through the TCFD framework, but for Calpers, this voluntary best practice reporting, we like the TCFD very much, but we want to see that integrated into mandatory financial reporting so that the reporting by companies is timely, it's relevant, it's within the internal control cycle, and also the audit committee and the auditor have a role to play in the assurance. So where we are now is we have something like 50 of the 100+ companies in Climate Action 100+ have made those commitments. So we're starting to get some big results, but there's more to do. And these aren't the only companies that matter. But I think it is a good example of the power of finance when it's deployed for the long term and with this idea of sustainability in mind.
And with the Climate 100, how does that change your view in terms of the engage versus divest argument? And for those companies that clearly do engage, then it shows, we should have rightly an optimistic view as towards transition and towards change. For the companies identified who do not then sign up and fully engage with shareholders, where does that take us in the engage and divest discussion? So if we could see in the past, for example, big tobacco, and there was variances between companies as to how they were being engaged and how they were changing their business model. And I guess we're seeing the same thing amongst the oil majors, and to contrast, for example, Exxon versus Total. Where do you think that takes us, Anne, going forward?
Yeah, it's a very good question. So it's an issue about what's your theory of change, and also about risk. So let's take the first one. Divestment doesn't take money away from the company. What happens with divestment is you have a company, typically this happens in the public market. So company is listed, shares are sold at the listing, and if I choose to divest, I sell those shares to someone else. It doesn't really have any direct impact on the company. And if your theory of change is you want this company to stop doing something or start doing something, simply transferring shares from one investor to another investor is, to us, simply not going to have an impact. Now, you may choose to sell your shares because you see a risk or you don't see an alignment with your investment objectives. That's an investment decision. So divestment isn't really the term that we would use when we make decisions to move money from one place to another. That's part of a risk decision. So that's one thing. Does divestment have an impact on the shareholder, on the equity markets? The second question I think that we've thought about a lot here is even if we decided to sell our shares, it doesn't deal with the risk, because if we walk away from a company and the company carries on belching emissions directly into the air or through their supply lines or their value chain, those emissions are what are causing global warming, and global warming is causing the risks to our portfolio. So simply walking away from the company that's belching the emissions isn't going to stop. The ultimate goal is to bring emissions down, and at scale and at pace. So Calpers' first move is always, because of our size, because of our ability to work with other investors, it's always to say, how far can we take engagement as a change, as a catalyst for change? I think the results we're getting demonstrate that we can get a lot done. However, what do we do when a company just won't budge? I think that's a really serious question. First, to the investor community. So I think Exxon versus Shell, BP, Repsol is probably a good example. So where we are with Exxon is, you'll recall a few years ago in a series, several votes were won at Exxon. One on climate risk reporting, which people pay attention to, but there were two others prior to that which are arguably as important. And one was on what's called majority voting. Because in the United States, companies do not have to allow shareholders to vote against the board of directors. I mean, under Delaware law, the default provision is you can either vote yes or you can sit on your hands. So this is not really a very robust form of corporate accountability. So, you know, Calpers, with many other investors, has been working hard on this over the last 10 years to say you have to be able to vote no, as well as yes, when there's an election for the board. Now, in this context, that governance issue is not really thought of as an environmental issue at all. It's a governance issue. Why does that matter? Because unless that's in place, you can't hold the board accountable. And ultimately, if there are a group of directors who can't, won't, don't see the logic, or they're at the end of their career and, you know, it's just too much taking on something which is there's long-term complex, who knows what the reason might be, then it's time for new directors. So this ability to vote against the board at a company like Exxon is absolutely vital. And this season, you saw not just Calpers, but also big fund managers like BlackRock voting against the directors at the board of Exxon. Now, that is a little fire that can spread rapidly. And that's a vivid image for us here in California. Investors moving to the next stage, which is not just to request, but to require that companies come in line. That's part of the evolution of the idea of stewardship. You know, you start off saying, please, would you? And we have to move to this is necessary and it must happen. You know, so this is where you say the company's the immovable object. Well, finance, we're the irresistible force. So being able to marshal that influence is vitally important. And I would say, you know, even with Climate Action 100+, I don't think there's before been an effort at this scale to get financial asset owners and managers organized to cooperate, form an alliance around such a specific goal. So as investors, we're learning as we go as well about how to do this without tripping over concert party rules or regulatory concerns or dealing with insider information. And also another challenge that we have with this is, you know, when we did this work, again, led by Divya Mankikar at Calpers, to identify where these systemically important carbon emitters are. A third of them are in North America, a third are in Europe, and a third are in Asia. And then we've got a handful of other plus companies, as we call them, which are important in the regions, which means we have some companies, for example, we have a cement company in Nigeria, a company in Mexico, one in Brazil. That's in the plus list. The point here is that in some of these markets, the idea of stewardship or ownership responsibilities by investors is quite new. So all credit to the regional networks which underpin Climate Action 100+. We have those networks through PRI for the global companies, Ceres in North America, IIGCC in Europe, their sister initiative with a similar acronym in Australasia, and also the Asia group, which is really now going from strength to strength because we're engaging companies through that channel in India, in China, in Indonesia. And there we're facing another challenge, which is shareholders don't call the shots. We're in markets where government or state ownership can be very significant, if not dominant. So this is why we need this twin track of the private financial markets with the people's money coming forward to move this change. But we've also got to really rely on governments who may then be part of the owners, the part owners of the companies that we need to engage. The commitments that are made under the Paris Agreement, under COP26 coming up, are just so vitally important. So, you know, China's recent commitment to be net zero at a date that's been, you know, that may need to come forwards, but it's been set. This is vitally important because that sets the context within which investors can then come in and engage companies and help, you know, help support that transition.
Great, and fantastic points. And this is where this leads me to, from one asset owner to another. The ask for me feels that we want companies to move towards and move left towards social capitalism, which conjures up teachings of Adam Smith and Hume, and you can see that, as you say, in that the Napoleonic models we see in German GmbHs where you have democratic representation. That doesn't feel to me what the US experience is, which still seems very firmly founded on a right-wing version of capitalism, which comes from the Austrian school and very much Hayek. How easy is it going to be to convince American companies to move left, given US's paranoia about all things socialist?
Well, here's the thing. The issue is not moving right or left. It's about moving forwards. And if we don't move forwards, we fail. And that really isn't a party political issue. Now, the United States is a very big place. And the federal government has a role and responsibilities, particularly around issues like disclosure, market information. But corporate law exists at state level. And Calpers is at home. Our home is California. That's where I live and where I work. That's where Calpers is. And you will see that what's happening in California with wildfires, with the impact of the drought, with the vulnerability to sea level rise and extreme weather events, people in California understand what this risk is because it's not something distant in the future. This is something happening right now. And you'll have seen how, California's own political leadership has responded to this. The governor deciding it's time for California, which is, I believe, the 5th biggest economy in the world, to follow the lead of the 15 or 16 other countries which have set a date for phasing out the internal combustion engine. You've just seen, California is a place of innovation. This is where Silicon Valley lives. It's also a place full of creativity and ideas, and this is Hollywood, but it's also a place where the beauty of the natural environment is greatly prized, and that's very much part of California culture. So I would be careful about just saying that what the party political agenda is what drives this. There are two powerful things which are driving this, and they apply whichever market you're in. They apply whichever political persuasion you may have, and that is the science. Look at the data, look at what's happening, and finance. And if you put science and you put finance together, you've got a powerful force. And party politics ultimately can't stand up to that combination. And I also want to say the other vitally important piece in all of this is civil society, that the people who elect policymakers, put governments in power, the people who spend their money buying things, be it food or cars or bicycles or train tickets, the wider society will drive the pace and the range of this change. And I'm an optimist. I believe, I don't really follow Adam Smith's idea about human motivations. He always said, it's not because the baker feels like being kind that he bakes the bread and sells it. He does it for his own financial interest. Now, there's a truth in that. But I also truly believe that what has made humanity successful, or as successful as we've been able to be, is through cooperation and through kindness. And that ability to cooperate and to take care and to be a community is the only reason that human beings got this far. And we need to have that same thinking in our financial system. This is the common wealth. This is the wealth which is produced by so many people's work and so many people's savings. And that common wealth needs to be harnessed to the common good. And so the role of asset owners, pension funds, is actually going to be part of the solution in the next phase. And politicians are very important, regulators are very important, but we've got finance and we have science. And I think wider society will propel both of those, and hopefully we get through the noise and the nonsense that can come around because of the political cycle. We just have to see above and beyond that.
Powerful stuff, Anne. I mean, I think this is what sets the call to action for other investors and other asset owners. And you touch on commonwealth a number of occasions today, and how that links into a common purpose. And Smith himself said that no society can surely be flourishing and happy of which a far greater part of the members are poor and miserable. So it feels perhaps we have to fix one to also help fix the other, or perhaps they are mutually supporting. And I think that's a powerful way to finish the day. It's been lovely chatting with you. I think many asset owners will have gone through similar struggles and deliberations as we have over the years. And just to ask, what is your call to action that you would leave them with to help close out today?
Pay attention to your proxy votes. When you or your fund manager, whether you're a small investor or a big one, you buy shares in a company, it's called equity. That means you own a little piece of that company. That's your equity in that company. That will come with voting rights. So what is going to drive change is through the voting. So that, when you look ahead to next year's voting opportunities, make sure that you've asked your manager or asked your pension fund or your mutual fund or your insurance company how they'll be voting on climate change resolutions, and how they'll be voting on the auditor. How are they voting on the audit committee? Have they integrated all of these financial risks into the numbers that are coming forwards? Or are we getting some, version of a green Ponzi scheme, as David Pitt Watson likes to call it? Make sure that there is accountability. And at the moment, it's quite an effort to get the vote out. But that vote is powerful. And that's how we hold boards accountable for what they're doing, but also it's how investors send the signal that it's time for change. So the money's in your hands, the votes come with it. So don't miss an opportunity to make a difference. Be the change that you want to see in the world. Thank you. It's on many mugs, courtesy of the wonderful Mahatma Gandhi. But being the change in finance means you've got to make sure your money follows the issue, and that means following your votes.
Thank you very much.
And go to the PRI website if you need to get some ideas.
PRI website, everybody. And I'm just waiting on the call from David, who will invariably correct my Smith citation and correct any errors. That's inevitable. Anne Simpson, it's been absolutely fantastic chatting with you. Thank you very much for attending Ethical Finance 2020, and I look forward to chatting again sometime soon. Thank you.
Yeah, thank you so much. Bye.